Yo guys, welcome back to the channel, welcome back to Stock Talk Insider. So it's been a while since I uploaded, a while, it's been a couple of days, but I was very busy over the last few days, so that's the reason why. So going straight into what I want to talk about is that we're diving into the big question: are we heading into a US recession or not by the end of 2025, or will the strength of big tech and AI boom keep markets afloat? Let's break it all down. So thanks for all the support, by the way. I really appreciate it. If you would like to leave a like on this video and maybe even subscribe, that would be very, very, very nice. So going in, the first thing is the warning signals. So first, let's start with the economic red flags. So this is one of the things, but first I will talk about that the US labor market is cooling off. Weekly jobless claims are trending higher and unemployment has ticked up from earlier this year. Historically, rising unemployment by even 0.5% is one of the clearest signs that a slowdown is coming. Next, the leading economic index, the LI. This index combines 10 forward-looking indicators like building permits, new orders, and credit conditions. The LI has now declined for more than 6 straight months. Every single time this has happened in the past 50 years, a recession has eventually followed. So this is the LI, and this is how it's going. The blue line is the LI, and the black one is the CEI. Finally, the consumer. The US economy runs 70% on consumer, so that's actually more than 2/3 almost on consumer spending. And right now we're seeing weakness in retail and middle class spending, higher credit and card delinquencies, and slower growth for companies that serve the average household. But you won't see any problems in the S&P because of that, because the biggest companies drive the S&P the most. So all of the smaller companies should be going worse altogether to throw the S&P downward. But yeah, still there's still a little bit of stability in a couple of companies, and then also taking all of the biggest tech companies just growing double digits will not take the S&P 500 that much down at this point. But you do see that there are warning signals, and there are in fact good reasons that the market can go down for a couple of percentage, but yeah, for now there is still a lot of stability and not really a reason for the S&P to go down, because there will also be a lot of rate cuts. But then again, rate cuts are not immediately also the reason that the stock market will go up. So we already went up pretty much since April, but since April we also only have been going up and not really going down. So I do see in October that there can be, or maybe even in November, that there can be a downtrend. But still, if earnings come in end of October and beginning of November, and those earnings are all very good and stable, then the market will probably just go back up, and maybe because of that, we'll see a little downtrend in October, in my opinion. There are talks about that there will be a 2018 type of play, that the rest of 2025 would be going down, and that there would be almost a recession. But talking about it, it's actually more of a bigger correction, of course. So talking about earnings that are still looking strong, as I said before, here's the paradox. Well, corporate earnings overall are still healthy, as I said. In particular, companies serving wealthier clients, luxury brands, and especially B2B players are reporting strong results. So that's literally the big tech and all of the luxury companies and brands. And above all, big tech is carrying the market again, as I said before. Apple, Microsoft, Amazon, Google, Meta, of course, Tesla is not really putting up the good numbers, but that's something on its own. And Nvidia. Together, these magnificent 7 represent over 30% of the S&P 500 and nearly half of the Nasdaq 100. As long as they keep posting double-digit earnings growth, they can mask a lot of the weakness in the broader economy, of course, and also with the AI wind. So having said that, we go to the AI effect. Then there's AI, Nvidia's record-breaking sales, AMD's roadmap, and massive cloud spending from Microsoft, Amazon, and Google. This is the single most powerful growth narrative in the markets today. It's not just hype. Companies are spending billions, that's a fact, on data centers and accelerators. By the way, I own a stock. AMD is the leading in data centers, so just saying. And investors see AI as the next decade's growth driver that gives the market what I like to call an AI airbag. Every dip is bought because the growth story is simply too big to ignore. Valuations and the risk of correction are the next one we'll talk about, and that's the valuation. So the S&P 500 is currently trading around 21 to 22 times forward earnings. Historically, the long-term average is closer to 15. But of course, on today's news, you have things like AI. So things like AI have never been here before, and I do believe that you can compare that with something like the Industrial Revolution. Things were also in a much higher forward PE than you look at normal times and normal decades when there's not really a revolution, just good numbers. Then of course the average comes down to 15, but now we really have the AI acceleration and all of the revolution talks about AI. So that brings it to like 21, 22, and of course all of the new all-time highs we always hit. So again, historically, the long-term average is closer to 15. To return to that average, the index would need to fall between roughly 29 to 32%. So that means a very big correction of 29 to 32% in the S&P 500 to get that 15% again. 15 times for forward earnings. So back toward the 4,500 and the 4,700 range, assuming earnings stay flat. If earnings actually decline in a recession, the index might need to fall even further to normalize valuations. But of course, in today's markets, there's not a lot of people talking about valuations and is it priced fairly. It's more of the thing like, can we pump it higher on that news or that news? So going further, cash on the sidelines, one important factor to consider is the enormous amount of cash that investors are holding. Me, myself, am not that big on cash at this time, but I am working on it because I do believe that October can be a nice opportunity, and especially somewhere in 26 we'll have an opportunity. Overall, US money market funds have over 7.3 trillion in assets, with a significant portion coming from retail investors, which is almost 3 trillion. This shows caution. Investors are sitting on cash, waiting for clarity on macro conditions, interest rates, and inflation. This liquidity can act as fuel for the next market move if sentiment shifts positive or a dip occurs. A lot of cash could flow into stocks, potentially cushioning declines, but that's something we're already talking about since April actually and before. But it also means investors are ready to react quickly to bad news. The outlook is that, my personal take, with that, the recession signals are real. Labor markets are softening. The lie is flashing red and going down for like the last 6 months. And the consumer under pressure. I expect a pullback in October as some of these risks start to reflect in the market. A lot of analysts are also predicting this. Smaller consumer-facing stocks may see the first declines, and also a lot of retailers just feel it. That there should be, in my opinion, just bare minimum a small breather. So, however, big tech and AI are likely to continue driving double-digit growth. Apple, Microsoft, Amazon, Nvidia, Meta, and Google may remain resilient, keeping the index support despite broader weakness. The real risks come if big tech is slowed down, of course, if cloud growth cools, if AI spending pauses, or if margin compress under higher costs. That's when the market could finally reprice sharply. And even if big tech continues to deliver strong earnings, markets are still vulnerable to black swan events, geopolitical shocks, and regulatory surprises, or even suddenly liquidity squeezes. In that case, sentiment can only Sentiment alone can drive a significant sell-off even while fundamentals for the biggest companies remain intact. So, until then, expect volatility, maybe corrections in consumer-facing stocks, but no full-blown crash unless the Magnificent Seven stumble or unless unexpected external shocks hit the system. So, are we heading for a recession? The data says yes. Are markets ready to crash? Not yet, because the biggest players are still delivering and going up. This is a market of two realities: weakness on Main Street, but strength on Wall Street's biggest names. Keep watching Job, don't lie, big tech earnings, global headlines, and liquidity levels. Those will tell us when the balance finally shifts. So if you found this breakdown very helpful, make sure to like, subscribe, and share your thoughts in the comments. And do you think the AI boom is ready for a crash? And cash on the sidelines can keep us from a recession. So, having said all of that, thanks for watching, and I'll see you guys later.